Understanding net interest margin, a crucial financial metric. Net interest margin, NIM, is a key indicator of the profitability of banks and financial institutions. It tracks a lender's net interest income generated from its lending activities, such as loans and mortgages, minus the expenses incurred from paying interest on deposits and other liabilities. Expressed as a percentage, NIM provides an insight into how effectively a financial entity manages its resources and operations, thus enabling investors to gauge the firm's long-term viability. The basics of net interest margin. Definition and significance. Net interest margin, NIM, is defined as \text net interest margin equals \frac text IR text IE text average earning assets where IR investment returns total interest income earned on loans and other earning assets, IE interest expenses total interest paid on deposits and other borrowings. A positive NIM indicates that a financial institution earns more from its lending activities than it spends on interest payments, signaling efficient operations and profitability. Conversely, a negative NIM suggests that expenses are outpacing income, pointing to potential inefficiencies that may require corrective measures, such as debt repayment or reallocating resources to more lucrative investments. A practical example. To illustrate, consider a hypothetical company ABC, which shows an investment return of $1 million, an interest expense of $2 million, and average earning assets amounting to $10 million. Using the NIM formula. \text net interest margin equals \frac 1 million to 2 million, 10 million equals -10%. This result indicates that the company is losing more due to interest expenses than it earns from investments, a distressing sign for potential investors. As of March 31, 2024, the average NIM for all FDIC-insured institutions was 3.17%, which stands as a reference point for evaluating a bank's performance. Factors affecting net interest margin. Several dynamic factors influence a financial institution's NIM. 1. Supply and demand dynamics. The balance between demand for loans and savings impacts NIM significantly. If more customers desire savings accounts than loans, banks must pay higher interest, reducing NIM. Conversely, strong demand for loans increases NIM when higher interest charges can be applied to borrowers. 2. Monetary policy influence. Monetary policies shaped by central banks can have profound effects on NIM. For instance, low interest rates typically encourage borrowing while discouraging saving, thus boosting NIM. In contrast, higher interest rates can lead to reduced borrowing, which can negatively impact banks' margins. 3. Product mix and interest rates. The diversity and types of lending products offered by financial institutions also affect NIM. Credit cards, for example, usually carry much higher interest rates compared to mortgages, thereby skewing the NIM positively for banks focusing on credit products. Impact of economic cycles on NIM. Historical trends show that average NIM often correlates with economic cycles. The Federal Financial Institutions Examination Council, FFIEC, reports that NIM trends downward during recessions and generally rebounds sharply in recovery periods. Since 1984, the average net interest margin for U.S. banks has hovered around 3.3% to 3.8%. The aftermath of the 2008 financial crisis, for example, saw a dramatic decline in NIM as rates approached near zero levels. Historical overview. Analysis shows that NIM experiences fluctuations in tandem with federal funds rates, with notable impacts during recessionary periods. Following the 2008 crisis, U.S. banks saw their NIM decline markedly until it began to recover around 2015. Retail banking and understanding net interest margin. In retail banking, institutions offer interest to customers on deposits while charging higher interest rates on loans. For instance, a bank might pay a 1% interest on deposits and then lend those deposits at a 5% interest rate. This 4% difference contributes to its net interest spread, reflected in the net interest margin. Example scenarios. Consider a bank with earning assets of $1.2 million. $1 million in deposits at 1% annual interest. $900,000 loaned out at a 5% interest rate. The bank's investment returns would amount to $45,000, and its interest expenses would total $10,000, leading to text, net interest margin equals frac, 45,000 to 10,000, 1,200,000 approximate 2.92 %. Such a positive NIM may attract potential investors by signaling that the bank is effectively leveraging its assets. Conclusion: the bottom line on NIM. Net interest margin is an essential metric for evaluating the operational efficiency and profitability of banks and financial institutions. Understanding its components and the various factors that influence it enables investors to make informed decisions. A healthy NIM signifies adept management of lending practices and resource allocation, while a declining or negative NIM may prompt serious re-evaluation of a financial firm's strategy and direction. In an evolving economic landscape, monitoring net interest margins remains integral to assessing the performance of financial institutions as they navigate different interest rate environments and consumer behaviors.